A friend of mine always complained about the charts provided on his broker's platform. His main issue was that he felt his broker didn't relay all the price points, therefore the charts often looked broken. Fed up of his constant nagging, I finally asked this friend of mine to show the chart that looked non-continuous and broken. And when I saw the chart, it was clear that the problem was not with the charts, but his understanding of charts. If you're new to reading stock charts, then I'm fairly certain you would have seen this as well. But then this is a fairly common phenomena and it's called gaps in the chart. Most new traders find gaps odd and non-intuitive. Let me explain how these gaps occur in the first place and how you should treat them in the chart that you're analyzing. There are basically two types of gaps, gap up and gap down. While these gaps can occur anywhere in the chart, gaps usually occur at market open. Here is how a gap up looks on a chart, and this is how a gap down looks on the chart. To understand why these gaps occur, you need to understand the price action logic. Consider this example. We all know how tough the situation was during COVID-19. Along with all the chaos that COVID-19 created, it also choked the supply chain logistics across the world. The supply of goods, especially electronic items, was suddenly disrupted and there was a massive short supply. While on one side the supply chain dynamics were playing out, on the other side there was a demand spike, especially for laptops. Given this, what do you think happened to the prices of laptops? Well, they shot up. Vendors started demanding 55,000 for a regular laptop, which was otherwise retailing at 35,000. And this price change happened overnight. Unfortunately, the vendors were not even willing to negotiate. The demand was so high and the buyers were willing to pay that price. In a sense, you can say that the price of a laptop gap upped overnight from 35,000 all the way up to 50,000. Now the same thing happens in the stock market as well. Assume it's a normal trading day for a stock, maybe HCL Tech. Let's say the price of the stock closed at 1,900 per share. After the market closes, the company holds a press meet to announce its quarterly results. Unlike what everyone's expecting, the company reports a stellar quarterly earning. What do you think will happen to the stock price tomorrow? Do you think it'll still open at 1,900? Well, obviously not. Traders would be willing to pay a price much higher than 1900. Could be 1925, could be 1950 or 1975, but definitely not 1900. For the sake of this discussion, let's assume it's 1950. So the next day when the market opens, the stock directly trades at 1950. This means to say that there were no trades between 1900 and 1950, and this creates a gap up opening. So you see, the chart is not broken, but there was a price jump thanks to the demand. Now imagine, instead of an extraordinary result, the results were terrible. Do you still think the price would open at 1900? Obviously not. Traders would want to sell this stock. It could be at any price. It could be at any price below 1900. Could be 1875, 1850 or even 1825. Assume it's 1875. Now in this case, there would be no trades from 1900 to 1875 and the stock would directly open at 1875. This is called a gap down opening. While in this example, gap up and gap down were created because of a news-driven event. But not all gaps are driven by news. Sometimes small gaps regularly occur in the chart owing to simple demand-supply situation. For example, assume the daily buy order for a stock is about 1000 quantities. Now for whatever reason, on a particular day there is 20% more demand for this stock. In that case, it would be common to see a small gap up opening for the stock. So gaps in chart is fairly common. Here are a few things that you can keep in mind when you see a gap in the chart. Firstly, don't overanalyze gaps. Big gaps occur when there is a big and sudden demand-supply shock in the stock, and this can happen more frequently than you can imagine. If you already have a long position and a gap occurs post that, then don't be in a hurry to book your profits. Enjoy the price surge and don't forget to trail your stop loss. If you do not have a position, then be doubly careful while initiating a new position. Usually, when a significant gap occurs, the stop loss can be deep. If a gap occurs on low volume, then be careful. This is usually an indication that a gap is driven by liquidity issues more than any underlying news. People often talk about gap filling, where they expect the price to come back to fill the gap. For example, if a stock has gap upped from 250 to 260, then traders expect the gap to be filled and the stock to retrace back from 260 to 250. I personally don't find any merit in this. But do comment below and let me know how you treat and trade these gaps on your chart.